What's up, guys? If you have money in any of the following places, you need to get your money out quickly. Today, we're going to give you an overview of what's happening in the broader crypto space with Blockfi, Celsius, Voyager, and 3 Arrows Capital so that you know what's actually going on. First, let's take a look at what's happening with Blockfi. Blockfi is essentially a crypto lending platform. You deposit your crypto assets over there. They lend those crypto assets out for a high interest rate and they give you a cut, they keep a cut themselves. The issue came when the market crashed, and even after margin calling some of their borrowers, they couldn't recoup enough assets to pay back the people who deposited with them. Now, essentially the company's going bankrupt and people are wondering whether depositors are going to be able to get their funds back. Okay, just take a second and listen to how bad this situation is.
So essentially what they're saying is with $15 billion or more under management, they have a lot of customer money, and FTX is willing to put their $250 million behind that money so that customers get paid back first. So here it says, otherwise depositors would have to wait for a new lender to be repaid, he added. Potentially how this plays out, depositors could be at risk of not getting their money back at all. While we know they have about $15 billion under management, we don't know what their balance sheet looks like. We don't know what their liquidity is. We do know this, it must be not very good because they're talking about $250 million being the difference between staying in business and not staying in business, and having clients' deposits at risk versus not at risk.
Blockfi isn't the only institution that this is happening to. Celsius is essentially in the exact same boat. Coin Bureau did a great job of explaining essentially what's going on with Celsius. Take a listen real quick.
Speaking of massive losses, it seems that Celsius hasn't managed to make the recovery that many had hoped. The crypto platform's downfall was ultimately caused by risky yield-seeking behavior, combined with a fall in the price of Lido Finance's ST-ETH relative to ETH. Celsius was badly in debt, which makes sense when you remember that Celsius's own About page notes that the platform had processed over $8 billion in loans. While it's not clear how much had been borrowed when Celsius closed its doors, what is clear is that the value of the crypto used as collateral was likely liquidated when crypto prices crashed earlier this month. These and other obligations could have left Celsius underwater, i.e. owing money to other parties which it had borrowed these billions from. History suggests that Celsius users will be lucky to get some fiat back, and this compensation could come months or even years after Celsius has gone under. I suspect the first folks to get this fiat will be the individuals and institutions at the top of the Celsius food chain. But let's hope it doesn't come to that.
Now, let's take a look at Voyager. It honestly feels like it's on the exact same track as Celsius and Blockfi. Voyager took out a $500 million loan from Alameda to pay back depositors. This sounds good at face value, but take a listen to why this might not be as positive as it seems.
So you can see from June 20th to June 24th, they went from $152 million in cash in crypto down to $137 million in cash in crypto. So that's $15 million that they're down. However, in addition to that, you're going to see this paragraph says the company has accessed $75 million of the line of credit made available by Alameda and may continue to make use of Alameda facilities to facilitate customer orders and withdrawals as needed. In this 4 days, they used $90 million of their liquidity. They only have $137 million in liquidity left. So the question is, how long can this last them? And here's the problem. Even though they say in the press release, the company has accessed $75 million of the line of credit made available by Alameda and may continue to make use of the Alameda facilities, I want to show you a clause in this loan. The loan is $200 million of cash and 15,000 Bitcoin. So altogether, this is about a $500 million loan. So under item number 2 on the loan agreement, item 2.3 says funding restrictions, and in no event shall more than $75 million be funded in any rolling 30-day period in the aggregate for both loans. So if I go back to this schedule that I made, they have $137 million left in liquidity. They've borrowed everything they can for now. This clock will reset, in late July, and they can borrow another $75 million. But the question is, can this $137 million get them from here? That's almost a full month away from now. And again, they used $90 million in 4 days.
This brings us to 3 Arrows Capital, a venture capitalist firm that was and still is completely over-leveraged in the crypto space. One way or another, 3 Arrows is connected to many DeFi and CeFi projects out currently. 3 Arrows Capital was taking out large leveraged loans from Blockfi, Celsius, Voyager, and more to then take out additional leveraged loans to make large bets on Terra Luna, staked ETH, and a Bitcoin ETF, all of which have had massive problems lately, as well as tens of DeFi projects. Take a listen to what happened to them when the market crashed and how it ties into what's happening to Blockfi, Celsius, and Voyager.
And I'll just start with this 3 Arrows Capital story, because this is one of the most prominent hedge funds in the crypto space. It's highly leveraged bets that it took on the markets, and we're now starting to see that unravel as we've come to see this market crash in the crypto space. They failed to meet a number of margin calls. Blockfi, a lending firm in the crypto space, reportedly liquidated some positions from 3 Arrows Capital. The company also had exposure to the collapsed Terra USD algorithmic stablecoin, as well as the subsequent crash of Luna as well. And so it suffered heavy losses from that. Now you're seeing it unable to meet that repayment of about $670 million to Voyager Capital, as Voyager Digital even as well. The risk is really for the market is how much the contagion might spread. We've seen some of the impact as well already. But what else is 3 Arrows Capital is exposed to? Will it have to dump a bunch of holdings? And there are any more large market players that could be exposed to 3 Arrows Capital? Those are the worries and questions at the moment. I think that's why you're seeing that pressure on Bitcoin today. There's a couple things at play here. Certainly, there are structural issues in the market, and we've seen that play out with some of these firms that are offering, 18% yields, i.e. Celsius, and the issues they've had there. And we've seen when it comes to market crashes, they happen to find themselves in liquidity issues, solvency issues, credit crunches as well. And so there are structural issues with the way a lot of these businesses are marketing and the setup.
If all of this feels strangely familiar, it should. This is exactly what happened in 2008. It's essentially a subprime lending event. It's basically the reason that Bitcoin was started, to stop bankers and people with lots of money from doing exactly what's happening in crypto today. Take a listen to why.
Basically, everybody was lending to each other. Everything was propped up, but nobody actually had assets to back up what they were, borrowing and lending. Instead of like these altcoins that are going to go to zero, it was these subprime mortgage-backed securities that was going on. Subprime lending just means that, you're lending to someone or an entity that isn't backed by enough assets, in case things go wrong, that it's backed up. When I take a look at this Harvard Business Review article, and they reflect on the Lehman Brothers situation where they basically, had to shut their doors, right? And the 3 biggest mistakes are noted. And again, this was back in 2009. Too much leverage, number 1, right? The basic concept of financial leverage is taking the proceeds of a loan and investing that money to receive a higher rate of return. Businesses such as banks borrow money from others through deposits or loans and pay a fixed interest rate on that debt. They then take out that borrowed money and invest it, expecting, of course, to get a higher return, right? So Voyager and Celsius, they were taking your money and they were investing in things that were giving them, in fact, a return that was higher than what they were paying you. And this is completely reflective of what happened to Lehman Brothers. Number 2, risky debt to equity ratios. Debt to equity ratios tell you how much debt a company has for every dollar of equity. Because just like in Lehman Brothers, it was like a 60-to-1, they said, which is bad, right? Banks are required to do 10-to-1, right? Which means that for every dollar of equity they have, the bank has $10 of debt. This debt to equity ratio is probably through the roof on a lot of these lending platforms, as well as, crypto hedge funds like 3 Arrows Capital.
When taken all together, this tells me that we are in for more downside in the market. I can't tell anyone what to do with their money because I'm not a financial advisor, but I personally am just waiting on the sidelines while I watch to see what happens when and if all these projects go under and people's money starts being sold at a 20% or more discount to large players, which is what liquidation is, and then those large players can then sell it on the market for instant gains. That's it for this episode, guys. I'll see you in the next video, and as always, we can keep talking about getting more coins.